Hello, everyone, and thank you so much for joining us for another webinar on our KingsCrowd Capital Fund. In this episode, you're going to be learning more about how we utilize ratings and data to identify potentially winning investment opportunities. As I've mentioned before, our KingsCrowd rating algorithm right now is outperforming the general market by about 30% versus the general kind of, if you invest in all of the deals that are out there. This is a really interesting and exciting development. And because of that, it's helped drive us to want to create one of our first fund products for this new online private market ecosystem. But obviously, we want to help people understand how this actually works, why it works, and what we're doing to continue to build out our system to be really, really powerful and really effective at creating winning investment opportunities and a really strong diversified investment fund. So with that, we're going to kick it off. Ahmed, thank you so much again for joining us here today.
Thanks for having me.
Of course. So Ahmed is our CIO. He's the brains behind the operation. He's the one who's created this rating algorithm alongside our investment research team. They've been working at this for years. And from that has come some really interesting insights and exciting opportunities for us to be able to build what we're building today. But obviously, I think one of the first questions you have to ask yourself is, how do we rate innovation? Because it's such a big question. So
yeah,
it's a bit about how we do that.
Yeah, man, I understand. We at KingsCrowd, we really understand that's very, very hard to judge innovative startups. We're not really judging them, or we're not really trying to say, hey, this is an innovative company and this is not. Many top investors have passed on really good companies, and they have also invested in really bad companies. So it's really hard to do that. We're not doing that. What we're trying is just to give investors some tools for them to be able to make an informed decision before they put their money, just for them to be more confident in their investments.
Makes a ton of sense. So obviously we're known for our ratings, right? What is the methodology behind those ratings?
Yeah, let's first maybe talk about two different things. There's predictive ratings or analysis, and there's descriptive analysis. In predictive analysis, you create a model to predict the future performance of the company, like revenues or the future valuation of a company. To do that, you will need data covering many years for startup operations and subsequent rounds. But the online private market is relatively still young. We don't have that much data yet. So although we don't have that data, we will get there in a few years, hopefully when more companies starting to get more rounds and get acquired or go public. So that's the predictive model. What we're doing now is descriptive. We analyze the present or the past of these companies, not the future, and then we compare them to each other.
Got it. That makes a ton of sense. And how do we actually compare them against each other? How do we do that?
Yeah, simply put, we collect data. We collect more than 300 data points on every single company, and then we again, let me talk more about why we decided to compare them to each other first, and then maybe we'll dig deeper into how we do that. So there was two options here. First, you either compare the company to a benchmark, like an ideal startup, or you compare companies to each other. But if you try to compare them to a benchmark, you get back to the point where how do you judge innovation? What is an ideal startup? What is that benchmark? And then for every industry, there would be a different benchmark. So we decided to go with the second approach, where we compare companies to each other.
I think it makes a ton of sense, and I just want to say something here, which is I think the venture industry in general has made a major mistake in how they talk about, we're incapable of making good decisions based on data when it comes to startup investing. That's only true when good data doesn't exist. But fortunately, in this new world that we work within, we have actual data. We have verified data, audited financials, real valuation terms. We know exactly how much they're raising. So it's a very different game. And when you're doing that, to try and start with what was ideal in a traditional venture world, the only thing that they've ever said is ideal in the venture world is to have the biggest funds invest in you. That's literally, there's a data-driven fund out there that has said our methodology is basically to just look at Andreessen and Lightspeed and the other massive funds, and whatever they invest in will be the winners. And it's a really, really silly thing to do. It's what you do when you don't have anything better, but there's a much better way when you have real data. So we are starting from the ground up, building something that's never been done before with a real database of verified data. I'm telling you, like, this to me is like what makes us so different. And this is our long-term differentiated moat, is that we're actually collecting true data, real financial data on thousands and thousands of early stage private companies in a way that has never been done before. So let's talk about how we actually rate that.
Can I add one more thing here?
Please.
The concept of the lead investor in traditional venture capital is basically what you're talking about. There's a lead investor who actually decides to invest in a company, and then many other co-investors would come and follow that lead investor. In our case, no, it's not somebody or some firm. In our case, it's the data that speaks about the company. We want it to be data-driven from day one. And this is what we're doing here. We've been doing that for 3 years. And we're launching the fund after all of those 3 years, and after testing and back testing and tracking the performance of our ratings and our data. So yeah, we're truly data driven in this approach. Back to your question and how actually the ratings work. As I mentioned, we collect like 300 data points of unstructured data. This is from like the crowdfunding platforms, the raise page on the platform, or the pitch decks that we see in the financials and the performance metrics, and from the SEC filings, from LinkedIn when we go and study the founders and their track record, their history, their education, their skills, and how long they've been together. And then we also collect data about on the competitors of these companies, and how good or bad the company is in comparison to the competitors. We do our own market research for every single company to come up with a realistic market size, target market size for these companies. So we pull information from so many resources, and we structure all of that data. And then what we do is basically back to the point of comparing them to each other. Let's take price, for example. It's one of the things, or the valuation, one of the things we focus on. You take the valuations of all these companies. And by the way, if the company is not raising equity on equity, I mean, if it's a safe or convertible note, we take the valuation cap. So you take all of these valuations and compare them to each other, meaning the company with the highest valuation will take the lowest score, and the company with the lowest valuation will take the highest score in that specific area of the ratings. We focus on 5 main categories on the ratings, and in each one of them, there's tens of other subcategories inside them. So first is price. And I mentioned the valuation, but it's not the only one. There's also the revenue multiple. And you've seen in this market, the revenue multiples are going down. It used to be last year and early maybe this year, we reached to really huge numbers when it comes to revenue multiples to evaluate public companies and private companies. But now things are being corrected and we're going down to normal levels. So there's a lot under price. Second is market. And as I mentioned, we do our own market sizing. We look at market growth rates, what risks are in this market, what's the market potential. So there's tens of data points under market as well. Under differentiation, we consider the number of direct competitors. We consider the is there the price of the product or service, the social impact, barriers to entry, patents, partnerships, all of that. And under performance, we look at the mainly the financial performance of the company, the revenues, the expenses, the burn rates, total capital, total assets relative to total liabilities, and a lot of other financial metrics. For the team, we take a deeper look at the team members, the founders, and of course other team members, the executives in the company. And we study them. We analyze or try to get data on how many years of relevant experience they have, what's the size of their network. And in here, let me mention something like for the relevant industry experience, there was a study done, I'm not sure it was MIT or Harvard, that when somebody comes to an industry, a newcomer to an industry, and spends 10 years in that industry, after 10 years they become kind of inside the box. They get used to this industry, and it's not easy for them to innovate and disrupt this industry. Now, if they spend 1 to 3 years, they still do not understand the industry well enough to be able to disrupt it from the inside. But the sweet spot is between 3 to 6 or 7 years. And in that period of time enables the person to understand the industry and still not be limited by the norms of that industry. And that sweet spot will basically help them innovate and disrupt that industry. So we take that into consideration as well. I want to mention one more thing.
Yeah, please do.
Because it's our proprietary data, and we created these data points and we collect the data. You can't find this type of data anywhere else. When it comes to the networks, the size of the network of the founders, of course, we look at their LinkedIn and we see how many unique universities do the founders have. Like, let's say there's a team, a founding team of 3, and they all went to the same university, the same undergrad university. So for them, they have a smaller network than a team of 3 that each one went to a different university. We take that into consideration as well. Lastly, what we do is we get all of these data points, compare them to each other, again, in each of these data points, and then we standardize the data, normalize it, and scale those values to come up with a score of 1 to 5. So after all of this hard work that's now automated, we give you the 1 to 5 score in only 5 categories.
Here's the coolest thing about this from my perspective. So when you're a traditional venture shop, you might get 1,000 emails a year of deals that you can look at. The reality is you're a handful of people in a small organization. You might take a cursory glance at the email, but you only have time to maybe look at 50 to 100 deals for real. And then from there, even, you don't necessarily have all the right information, and you got to get yourself to 5 or 10 investments. Here, our investment research team, which is a part of KingsCrowd Inc., is looking at about 1,500 to 2,000 deals a year and diving into every one of these 300 dimensions of the business. And then KingsCrowd Capital just gets served up the companies that are a 4 or above. So they cut out all of the noise, all of the companies that are out there trying to raise capital that are okay or have some red flags and all these issues, so on and so forth. And we go from almost 2,000 companies that are fully looked at, fully diligenced, and now we get ourselves to a universe of maybe 250, 300 companies, and we know what all of their strengths and weaknesses are in a really quick glance. So what we've done is we've made the selection process really, what's the right word? We're very structured in our process. Very disciplined. That's the word I was looking for. Very disciplined in our process. But we get to look at this small universe really efficiently. But in reality, our funnel is about 1,500 to 2,000 companies, but we get to spend our time with the best and have all the key information to say, okay, here's the strengths and weaknesses of all these businesses really, really quickly. So then we know exactly where to spend our time so that we can get to the best investments in a really quick way and a really smart way. That to me is just like a massive, massive win for the KingsCrowd Capital team. And anyway,
Chris,
I just think that's so unique.
And this is just the beginning. because over these 3 years, again, we were doing descriptive analysis. Now, maybe next year we can start getting into predictive analysis. And because we have all of this rich data that's going back 3-4 years back, so now maybe we can get in there and start trying. I wouldn't claim that we're there. We're still not there, but maybe we can start trying to predict the valuations of these companies in the next round, not necessarily at the exit phase. Maybe you can predict the revenues of these companies, the maybe number of employees within a year, how much time do they have, like their runways, and maybe predict when are they going to need capital the next round. So all of that, and maybe how many people would invest in them, because we know how many people invested in the previous rounds for all of these companies. So there's a ton of things that we can work on. So this is only the beginning.
Well, that's a perfect serve up to my next question for you here, which is, how do we actually measure the performance of our ratings and know that they're working?
Yeah, it's at the core of it, it's very simple. And what I'm talking about now, it's not back testing, because we've been rating companies and monitoring their performance as we go since we started. So we track the valuations of these companies as they raise more subsequent rounds. And then if the valuation grew, then and you invested in this company, this means you have achieved again. But it's basically, it's called unrealized return, because you still did not receive the money. You didn't exit this investment. So we looked at all of the highly rated companies by KingsCrowd and calculated the average of their unrealized return and compared that average to the market average of unrealized return of all companies, not just the highly rated ones. And then we realized, or we discovered that our highly rated companies are performing 30% better than all of the other companies in terms of unrealized returns. And not only that, they're less likely, 3x less likely, 3 times less likely to fail in raising the next round compared to all other companies.
It's really good for anyone who's wondering. And the valuation jump from when we rated them positively to now collectively is about a 3.5x. Is that correct?
Yes, that's correct. Yeah.
So
this might sound a small number, 3.5x, because usually when you hear about the big success stories about these companies, it's like 20, 40, 50x. But this is the average. And the average for the companies that did not get into the highly rated bucket, it's basically less than 2x. So we're talking about a big difference here. And we've seen companies in the online private market that went actually from 3 million to $300 million valuation, and they're really successful now.
That's really good. And just to be clear, the way that startup investing works is typically your winners take a while, 8 to 10 years. So that company that's at 300 million may very well end up at 3 billion or 30 billion over a decade, but it takes time to become a massive company. And the companies that are going to fail, they tend to fail fast. They don't fail slowly. They don't take 5 or 10 years to fail. They kind of fall out of the bucket pretty quickly. So right now you have a 3.5x, despite still being in the early part of the growth curve for these organizations that have been rated utilizing our rating algorithm. We've already seen it jump from, I think it was like a 3x earlier in the year to up to 3.5x when we went back and looked at how the companies are performing. So anyway, this was really, really helpful, Ahmed. Thank you so much for diving into how our system actually works. For those of you who are interested in learning more about our fund or want to invest directly, you could go to kingscrowd.com/capital. You can schedule time to speak with Ahmed himself if you want to learn more, or you can make an investment directly utilizing the links to AngelList, where you'll be able to make your investment. We're really, really excited to be able to offer this new and unique investment opportunity for our own customers. Hope this has been really helpful, and definitely join us for episode 3 when we continue to talk about what we're up to here at KingsCrowd Capital and who the team is behind what we're doing. Thank you so much, everyone, for your time today, and have a wonderful day.